right, so hey guys, this is Mark, or Ace from the forums. Seb mentioned he's giving me the pleasure to present July's financial results. And here we go. So just to kick things off, net interest income fell by nearly 50% month over month. It's lower demand for credit and decreased stability fees from the recent PPG proposal led to lower income. Net trading and liquidation income also fell tremendously at 78% and 95% down respectively. There's less pressure on the peg, and lower crypto volatility were the key drivers that led to lower income in each case. Workforce expenses were relatively flat from last month, and altogether our net income was down 63%. And recurring income was down 55%. Despite that, maker price increased about 12% from last month. On a year-over-year basis, things look much better. And personally, that's how I like to compare things. And the results were quite impressive. Every single metric is up, with net income and recurring income up, 27 and 93x respectively. So as you guys can see from the visual representation of the income statement, revenues continue to decline month over month, driven primarily by lower net interest income, with the lower stability fee rates and lower demand for credit leading to lower income. Workforce expenses, that little purple bar on the bottom, starting to creep up a little bit, and that'll continue to go higher in the coming months as more core units are onboarded. For the lending income slide, we had 4.4 million in lending income for the month, with our average yield falling to 2.7% from 4.6% last month. Loan balances are stabilizing with 2% growth prior month, and as collateral prices have started to rebound, we may see an increase in demand as our collateralization ratios increase. So Bitcoin and Ethereum both climbed, the mid to high teens last month, and hopefully we see some increase in loan and credit going forward. So the rapid increase in the USDC PSM has slowed from last month, and we only grew 6% in our stable coins. And the recent proposal from the PAX team could be a great opportunity to reduce our exposure and dependency on USDC. So hopefully everyone saw that post, and if not, go check it out in the forums. Taking a look at the balance sheet, it continues to grow, mostly due to that liquidity reserve, which is the stable coins. Mostly USDC at this point. Crypto loans are up slightly at about 2%. So good to see that starting to stabilize, and hopefully it'll continue to recover as crypto prices start to rally a little bit. And liquidation business has fell tremendously. Having low volatility is going to lead to lower liquidations, especially having lower downward volatility. And since we did see generally an increase in prices, especially in our large collaterals, it's going to usually lead to lower liquidation income. So only 56K last month, but not better than nothing. In terms of market share, on-chain, DAI month over month and year over year lagged the market. Had quite a difficult comp from last July. You can kind of see in the middle in July 2020, we had a huge spike from June to July due to that compound liquidity mining that began, and when DeFi summer really started to explode. In terms of market share, looking at the on-chain volume, been pretty stable the past few months. They're down 1% from last month, and last July we had that huge bump, which was definitely one-timer type of situation. But generally been pretty stable the past few months, and it looks like USDC continues to take share from Tether as well as Binance USD. Not really sure what's ended Binance's lack of growth, but looks like it's trending down more or less the past few months. So risk is definitely one of the brighter spots in the financials this month. We see increases in the key financial ratios, leverage and the CET1 ratio both up. It's great to see the CET1 ratio especially starting to climb into that 3 to 4.5% range, which I think from risk perspective is more suitable. We've definitely been below that, as it's been tough for the surplus buffer to keep up with the growth in our assets and in our loan portfolio. So our equity inclusive of operating wallets grew 10% from June. Risk-weighted assets grew 3%, and the CET1 ratio and leverage ratio increased 18 and 15 and 5 basis points respectively. So it's good. DAI remains very safe stablecoin.
Mark, quick question. When you say risk-weighted assets and equity, what would that be? Would that be the total of the collateral types locked in vaults over the buffer, or?
So our risk-weighted assets is anything that's generating interest, essentially.
Mm-hmm. Yeah.
Have the back stable coins out to get that, and to calculate the ratio, you just divide that by the equity.
Thanks.
Yep. So over to the earnings per MKR, saw an uptick in the equity per MKR of about $5. The earnings yield went down as lower income. We're essentially trading at a higher PE ratio as a result, with a big decrease in the ratio. But usually when you see a low earnings yield, especially in a business that's as volatile as Makers, generally, the market is looking forward and thinking that the prospects for that business will improve. So, it's good to see Makers price rebound a little bit. I think that's shows confidence in the protocol and also for DeFi for higher earnings going forward. So another bright spot in our financials are our real world assets, which grew 45% to 5.4 million this month. And I'm sure many saw the executive to raise the debt ceiling on the new silver vault pass, and now they have 20 million in capacity. So we should see continued growth there, and we should see continued growth from other assets as well. This deal flow remains pretty strong. Current focus for the team is on SolarX and the Cayman Foundation structure. So again, check those out in the forums if you haven't already. And just to wrap up, liquidity pool growth more than doubled compared to last month, and that was primarily driven by that DAI USDC Uniswap vault. You can see in orange here. We dropped the stability fees from 50 basis points to 0, so that was quickly taken up, and I think the DC has been reached already on that, and that's what led to the higher growth in liquidity pools. But I guess with that, anyone have any questions?
Yes, one thing I was curious about was kind of related to Juan's line of questioning there. With our risk ratios looking better despite revenues dropping, is that just because of the increased stablecoin exposure, or am I misunderstanding?
So the CET1 is excluding the stablecoins, and really it's been tough for our surplus buffer to keep up with the growth in assets, because if you grow your assets if our risk assets doubled today, right, our CET1 would just drop by half, right? We have to actually stay at a certain level of loans to start accruing equity in the surplus buffer. So if you grow too quickly, your safety measures are going to lag because you need time to have those loans accrue interest. So with the decrease in loan demand, we just started to see that income come in from the loans essentially, and that's why it keeps increasing. If loans doubled tomorrow, our ratio would go down. It would take time to catch back up.
Awesome, makes sense. Definitely encourage other questions. Probably got another 6 minutes or no, I can do math. 16 minutes we can spend on this. So yeah, if you got something, fire away.
I have a general question, about the CET1 measure. If let's say like we're in this environment, right, where the MKR price is fairly healthy. Our asset, the other part of the CET1 ratio is growing, but our surplus buffer isn't. Would people in the DAO be generally opposed or for like slight maker dilution in order to raise that surplus buffer and not necessarily rely on purely on our revenue streams for accruing that? And I'm curious, like, why you'd be opposed or why you'd be for it.
Yeah, I guess it comes down to how much risk, the community and governance wants to take in terms of our, safety ratios. I think that, generally risk has recommended higher ratios, and I think I've been pretty vocal about not wanting to burn Maker while we're below the recommended ratios. I think long-term, we definitely should align as a community on what an appropriate and targeted CET1 ratio and liquidity ratio or leverage ratio is, and then just start not burning Maker when we're not at those ratios. And then that way it's just kind of automatic. We could have certainly one-off situations where maybe the ratio is slightly low and we think it's a good opportunity to burn some MKR. Maybe we can handle that through separate signal request and vote. But generally, I think given how opposed people are to minting and taking higher risk to burn Maker, I think there's just no appetite for diluting holders to reach these appropriate risk measures.
So Peyton actually brought something up in the chat, the fact that we still have the 84,000 MKR that the foundation transferred to the protocol in the pause proxy. Yeah, and also just to give a little more context to this question, like I'm probably also leaning towards opposed, but my thinking is that like if we do go for a dilution, it usually happens when the MKR price is bottoming out and we end up taking a really bad haircut. Like that's what we saw on Black Thursday, right? Like we ended up selling a lot of MKR really, really low. But if we are lagging behind in our risk metric, right, this ratio, and MKR price is high, it seems like it might be wise to actually try to raise cash from any, maybe not purely diluted MKR, but MKR that we have free, like that 84K MKR might be an interesting tool to use. But yeah, I'm just thinking out loud, so I don't have an opinion one way or the other.
Yeah, I think ultimately we should probably define like a targeted measure. I know Seb's talked about the Basel III requirements that banks have in terms of risk measures they must follow. So I think as a community, we should look at these, work with risk, take the recommendations, and then lock in what we think is appropriate. I don't know that people want to dilute to get there, but hopefully we have time to get there before the market starts to rebound and loan demand takes off again.
Yeah, cool. Thanks for the thoughts.
And maybe one thing to add is that currently we have a buffer and that's great, but the main risk we face are tail risk. Whereas a buffer, I mean, if you have 1% or 4% and you are blacklisted on USDC or ETH is falling like a knife to $1, you lose everything. So having 1% buffer or 4% doesn't change anything. This will make sense more in the future where we will have real risk, smaller risk, but more diversified risk, and where the buffer is really important for that. But for now, it's true that we have mainly tail risk, so it doesn't change much. But it's important to think about that for the future as well, because if we have hyper growth, it will be difficult to raise.
Awesome. Definitely appreciate those reflections. There any other questions regarding financials, this presentation, before we move on to our last topic? All right, not seeing any. So Mark, thanks for presenting. That was really great. Always glad to see more faces during the presentations here.
Thanks, guys.